Equity trustees' role is to partner with the client and their trusted advisor in dealing with the financial and emotional challenges that come from the growth, preservation and intergenerational transition of wealth. The major highlights for financial year 2015, the year just completed, were the completion of the integration of ANZ trustees. We more than doubled operating profit, of course substantially driven in part by that acquisition, but also by successful organic growth in both of our two main business lines, Trustee and Wealth Services, or TWS, and Corporate Trustee Services, CTS. Both these businesses performed very well during the period, and in the case of TWS, of course, it was noticeable that this was done despite very significant effort that went into the integration project itself. When we look at some of the key operating results from the year, operating profit before tax more than doubled. It was up by 104% to $29 million. We had 75% improvement in net profit after tax, which of course is affected by some of the significant non-operating expenses that we had in the year. And of course, we also continue to see very successful growth in fund under management and administration. I was also very pleased to note that the operating margin grew from 27% to be a very healthy 35%. Both of our business units are operating very successfully. TWS has an operating margin of 27%, and as a wholesale business, of course, where it is slightly higher, CTS is operating at a margin of 48%. Both businesses made very significant contribution to the bottom line in terms of operating profit. The CTS business had another very successful year. At the end of June, we were responsible entity for 199 funds on behalf of 82 fund manager clients. Organic revenue growth exceeded 28% to $24 million, and fund under management and administration at the end of June exceeded $45 billion. Boosted, of course, by the acquisition of ANZ trustees, TWS generated 90% revenue growth. Fund under management and administration approached $8 billion, and the profit contribution from the business was in excess of $16 million. We've been very pleased with the way in which the relationship with the ANZ Bank has continued to develop. We certainly see that there are opportunities for each of us to provide services to joint client bases and to look to expand the range of services and products that we can make available. Both of us have a great investment in the wealth management industry and see it as a significant opportunity for the future. We often get asked how much of our revenue is driven by changes in asset market values, but this is in fact quite a difficult factor to isolate on its own. When we are managing or administering in excess of $50 billion across multiple asset classes in many different locations for different types of clients with different asset allocations, it's quite difficult to pull out one single influential factor that drives the relationship between fund under management or administration and revenue. But there is a broad correlation between changes in asset market values and revenue generation. We've spoken in recent periods about the need to increase the capital base to support the responsible entity activity driven by regulatory changes in basic capital obligations. We have managed that substantially through the dividend reinvestment program over a number of recent dividend payments, and expect that it will continue to be managed within those broad constraints. But the amount of additional capital that will be required now is quite modest in terms of our overall capital base, and we anticipate that it will be reached within the not too distant future. The board declared a fully franked final dividend of 48 cents per share, taking the full year dividend to 94 cents per share. We're very pleased to note that over the last 10 years, equity trustee shareholders have enjoyed a total shareholder return of 212%, which compares very favourably to the ASX 300 total shareholder return of 96% over the same period. Our focus for the current financial year, 2016, will be to leverage off the revenue synergy opportunities that we see coming to us from the successful completion of the ANZ integration project. We will be looking to drive continuing organic revenue growth in both of our CTS and TWS business units, to expand the range of services or products that we support, particularly in the CTS business, and to invest significantly in developing our professional competencies and functional capability, particularly in the development of a new, embracing and contemporary risk management framework. The completion of the acquisition of ANZ Trustees has been a watershed event in the company's history. We've often spoken about how we see a significant strategic opportunity in private wealth management, where we have a small market share in what is a massive industrial sector. And we see great opportunities ahead for the business when we continue to focus on some of those core activities that have been very good for us and for our stakeholders in the past. At the same time, we have a diversified business. We have a very strong business line in corporate trustee services, where we are a market leader in those segments that we want to participate in, and that business will also continue to grow and expand into the future. The company is in very good shape for the opportunities ahead. We're very focused on what we do. We tend to be very disciplined in our approach to business and to acquisitions in particular. And we see an enormous wave of wealth that is going to change hands over the next 20 to 30 years. And we provide very valued service and advice to people who want to manage that wealth and transition it to next generations. And our role in the philanthropic sector is one that we are very proud of. It helps us and it helps our clients put something back into the community on behalf of all of us.